Welcome back. In this lesson, we're diving into a critical financial concept: calculating the net present value, NPV, of a project. Before making any investment decisions, it's essential to assess the future cash flows that the project will generate. This is vital for understanding whether the project is financially viable. We need to know not just the amount of money the project will make, but also the timing of these cash flows, as this helps determine the actual value of the project. One thing to keep in mind is the time value of money. Simply put, a dollar received in the future is not the same as a dollar received today. This is why we discount future cash flows to bring them to their present value. For example, if someone wants to invest in a stock, they would estimate the future cash flows, discount them to the present, and then calculate the sum of those discounted values. If the result is higher than the initial investment, the investment is worthwhile. If not, it may not be financially feasible. Let's break this down using an example. Imagine a company plans to build a plant, and we need to calculate the net present value, NPV, of this project. Over the course of 5 years, the company expects the following cash flows: $30 in the first year, $120 in the second year, $250 in the third year, $200 in the fourth year, and $180 in the fifth year. The plant costs $300 to build, and the company's marginal borrowing rate is 9%. The financial director needs to figure out whether this investment is a good one. So calculating the net present value is crucial. To do this, we first discount each cash flow. The initial investment of $300 is spent today, which means it remains as a negative value of $300. For the next cash flow of $30, which will be received in 1 year, we apply a discount factor based on the interest rate. The formula is simple. Divide the cash flow by 1, plus the interest rate raised to the power of the number of years. For example, the cash flow for the year 1 will be divided by 1 plus the interest rate, elevated to the first degree, and so on for each subsequent year. Now, drag this formula to other years and fix the decimal points to 1. Once the discounted cash flows are calculated, we sum them up, including the initial investment. If the total is positive, the project is feasible and should be pursued. In this case, the sum is positive, so the project looks like a good investment. Now you may be wondering, couldn't Excel make this easier? Absolutely. Excel has a built-in NPV function that automatically discounts cash flows for you. However, it's important to note that this function is not always as flexible as manual calculations. The NPV function in Excel requires the interest rate and cash flow range as inputs. And once you've selected them, you can hit Enter. But here's the catch. The NPV function assumes the first cash flow occurs 1 period after the investment, so it excludes the initial investment. This is why the result you get might differ from the manual calculation. To make it work properly, the trick is to add the initial investment to the result of the NPV function. Let's do this. Type equals sum, then select the cell E8, where present value is written. Now, we have to add this in NPV of other years. So we will type NPV instead of second value. Then, select the interest rate again, which is in cell C4. Now, this time select the range from year 1 to 5. Close the bracket and hit Enter. When you do this, you'll get the same result as the manual calculation. This method is correct and will give you the accurate net present value. The concept of NPV is incredibly important because it's used in many financial decisions, whether it's for individuals or corporations. It helps evaluate the true value of a project or investment, considering the time value of money. I hope you're finding this exploration into finance exciting. We've covered some fundamental techniques that are used all the time in the business world. Stay tuned because in the next lesson, we'll dig even deeper into these concepts. See you there.